What if everything you've been taught about who controls money, who really runs the world? As economy's ICT just incomplete but fundamentally wrong. What if behind the governments, parliaments, and presidents, there exists a layer of financial power that operates above the political game, hidden in plain sight: central banks? These institutions print the money, regulate the interest rates, decide how much liquidity flows through markets, and in many ways, determine the economic fate of nations. And yet most of us never stop to ask, who really owns them? Are central banks government agencies? Are they independent? Are they, as some suspect, privately controlled networks serving elite interests? The answer isn't simple, but by the end of this story, we'll see that it's much stranger, more complex, and far more important than you might think. To understand who owns the world's central banks, we first have to go back in time to the moment the idea of a central bank was born. In the late 1600s, Europe was a chaotic financial experiment. Wars were expensive, monarchs were often bankrupt, and trade was exploding. Kings needed money fast, and traditional taxes weren't enough. Out of that desperation, the idea emerged. What if we create a bank that could lend to the government itself in exchange for special privileges? In 1694, the Bank of England was founded for exactly that reason. It wasn't a public institution as we imagine today. It was a joint stock company, created by private investors who lent money to the crown in exchange for a monopoly on issuing banknotes. The more the government borrowed, the more the bank earned. From the very beginning, money and power were intertwined. Governments needed funds. Bankers needed privileges. Central banking was born from that marriage of convenience, and it has stayed that way ever since. Over the next 2 centuries, the model spread. Sweden established the Riksbank, considered the oldest central bank in continuous operation. France created the Banque de France under Napoleon to control inflation and finance wars. Each of these institutions started as a hybrid, part public, part private, designed to stabilize economies, but also to serve the interests of their founding elites. Fast forward to the early 1900s, the Industrial Revolution had transformed economies. Trade was global. Crashes and banking panics were devastating. In the United States, the Panic of 1907 led to bank failures across the nation. The government had to act, but politicians didn't trust bankers, and bankers didn't trust politicians. Then came the moment that changed financial history forever. In 1910, a secret meeting took place on Jekyll Island, Georgia. A handful of the nation's most powerful bankers' representatives from J.P. Morgan, Rockefeller Interests, and Kuhn, Loeb & Co. met with Senator Nelson Aldrich. Their mission was simple but monumental: design a central banking system that would prevent future crises, stabilize the economy, and quietly protect the interests of both Wall Street and Washington. 3 years later, their blueprint became law. The Federal Reserve Act of 1913 created the Federal Reserve System, the U.S. Central Bank. But here's where the story twists. The Federal Reserve wasn't a government agency, nor was it a private bank. It was something in between, a hybrid structure with private ownership elements, but public control claims. The 12 regional Federal Reserve banks were owned by private member banks, which were required to buy stock in their regional Fed. But that stock didn't behave like real ownership. It couldn't be sold, traded, or used to influence policy. A central bank owned by private banks but controlled by the government but independent of both. The perfect triangle, the perfect confusion. Imagine this structure replicated across the world. Some central banks, like those of Canada, Japan, and Europe, became fully nationalized after World War II. Others, like Belgium, Greece, Italy, Switzerland, and South Africa, continued with mixed ownership. And some even allowed private shareholders to receive dividends, attend meetings, and hold ownership stakes. The more you dig, the murkier it gets. The justification was that independence protects economies from short-term political decisions. But independence without transparency can turn into unaccountable power. Then came the 20th century's breaking points. World War I forced central banks to print money for war. Germany's Reichsbank printed so much currency that by 1923, people needed wheelbarrows just to buy bread. The Great Depression exposed the fragility of these systems even further. The Fed's missteps deepened the crisis, and governments began reclaiming control. World War II pushed that control further. Nations needed stability. After 1945, the Bretton Woods system tied currencies to the US dollar and the dollar to gold. Central banks became guardians of a new global monetary order. But in 1971, President Nixon ended the dollar's convertibility to gold. The world entered the age of pure fiat money currency backed by nothing but trust. Central banks could now create unlimited money with a keystroke, and the world would never be the same. Inflation surged in the 1970s, inequality widened, global debt skyrocketed, and quietly, central banks became the most powerful institutions on earth. Then came 2008, the financial system imploded, banks failed, markets collapsed. Central banks stepped in with unprecedented action. They created trillions of dollars, euros, and yen electronically to bail out banks and stabilize markets. They called it quantitative easing, a polite phrase for printing money. The result? Asset prices soared. Housing became more unaffordable. The rich grew richer through rising stock markets. Wages stagnated. Economies became addicted to cheap money. People started asking again, who are central banks really serving? The Federal Reserve insists it is not owned by anyone, and legally that's true. But functionally, it exists in a tight relationship with the very banks it oversees. Private banks own the stock of regional feds. Wall Street influences monetary policy expectations, yet claims the system is independent. It's a design where everyone has power, and no one has full responsibility. Europe is no different. The European Central Bank (ECB) is owned by the governments of EU member states, yet it operates independently, with minimal democratic oversight, controlling the currency of 340 million people. In Switzerland, the Swiss National Bank literally has publicly traded shares on the stock market. Japan's central bank is nearly half owned by private investors. And many smaller nations have central banks whose structures blend public ownership with private or foreign influence. So who really owns the world's central banks? Here's the truth. Legally, most are owned by the state. Functionally, many are influenced by private financial interests. Realistically, none are directly accountable to ordinary citizens. But the story gets deeper. Since 2008, central bank balance sheets have blown up. The Federal Reserve grew from under $1 trillion to over $8 trillion. The European Central Bank reached 7 trillion euros. Central banks became the biggest holders of government debt, the biggest players in financial markets, the largest creators of money in human history. They became the market. And yet their ownership structures remained as technical and obscure as ever. Every crisis follows the same pattern. A crash happens. Banks panic. Central banks intervene. Markets recover. Debt grows. Inequality widens. No one is held accountable. Now a new frontier is emerging. Digital money. Central bank digital currencies, CBDCs. Imagine a world where the same opaque institutions that control interest rates also control every digital transaction. Who will own that future? Governments? Corporations? Or unaccountable hybrid central banks? This isn't conspiracy. This is the evolution of power. So what does all this mean for us? First takeaway: ownership does not equal control. Even where private shareholders exist, they rarely influence monetary policy. Control lies in structure, appointments, and global financial influence, not stock certificates. Second takeaway: structure shapes power. A central bank answerable to Parliament acts differently from one answerable to no one. Independence is important, but so is accountability. Third takeaway: transparency is the only protection. Central banks can create money, move markets, and reshape economies. They must be subject to clear oversight. Without transparency, public trust collapses. And when trust collapses, currencies follow. The warning is simple. When the institutions that create money become too powerful for citizens to question, democracy quietly weakens. And the open question remains, as digital money and global crises reshape the world, will central banks become guardians of stability or architects of control? In the end, central banks may not be owned by billionaires or governments alone, but they do own something far more powerful: the trust that money itself depends on. Without trust, there is no currency. Without currency, there is no economy. And without accountability, there is no trust. If this exploration challenged your assumptions, hit like, subscribe, and tell me in the comments which country's central bank you want me to explore next. Understanding money isn't optional anymore. Survival.